Hello everyone. My name is Anjani Kumar Khetan. I am based out of Bangalore. And in this particular video, what we will look at is that in the context of greenhouse gas emission reporting, what is the meaning of scope 1, scope 2 and scope 3 emission? And as an accountant and as a finance professional, we should have some amount of understanding in terms of what these emissions represent and how one need to differentiate between these three types of emissions. So that's the overarching objective with which I'm recording this particular video for the benefit of the larger professional community. So let us see what these three emissions are all about and how one need to differentiate. Now, scope 1, if you see the slide, scope 1 emissions represent all the direct emissions. All direct emissions which are emanating because of the sources that are owned or controlled by the entity. So the easiest example would be, let's say, a vehicle, a car, or let us say a jet, which is being used by the entity for commuting its executives. Now, if those jet uses the jet fuel or the car uses the petrol, then the emission originating on account of the use of such car or the jet, which is being controlled or owned by the entity, will fall within the definition of scope 1 emission. In contrast, when you look at scope 2, these are indirect emissions. Scope 2 are indirect emission, unlike scope 1, which are direct emission. So scope 2 represent indirect emissions, which are on account of the generation of emission from purchased electricity, which is consumed by the entity. Now, here, just you should understand the word used is electricity, but in fact, scope 2 will include all purchased electricity, steam, heating, or cooling. So all the four elements, though the word used is electricity, but the essence of the scope 2 emission is these are the emissions on account of the purchased electricity being consumed by the entity, though the sources. So for example, if a state electricity board is generating electricity, which you are buying from the state electricity board, then the emission is effectively happening at the state electricity board level. But because that electricity is being consumed by the entity, this is an indirect emission falling within scope 2 emissions. That's why scope 2 represent purchased not only the electricity, but steam, heating, and cooling. So this is scope 1 and scope 2. Now, you should also understand there is a concept called organizational boundary. The pink color boundary which you see here on the slide, it is representative of the organizational boundary. In fact, I plan to have a separate video when we talk about in granular details of these concepts. But at this point in time, it is suffice to understand that organizational boundary is a concept which is similar to what as an accountant we know the reporting entity. So for example, let us say if a legal entity has 3 different businesses. Now, which of the businesses should be included in the carbon footprint and the emission reporting, that is something is given by the organizational boundary. So which of the operations of the legal entity which is required to be included in the reporting of the carbon footprint, this is given by the concept called organizational boundary. This is something which, as I said, I plan to cover in greater detail in some other subsequent video. But scope 1 represents direct emission, scope 2 represent indirect emission. Now, there is something called scope 3 emission as well. Now, scope 3 emissions are also indirect emissions, but these indirect emissions are happening in the value chain, either the upstream value chain or downstream value chain. So these are scope 3 are also indirect. You can see the ones which are downstream is given at the bottom of the slide, and the ones which is the emissions which are happening upstream is given at the top of the slide. Now, what are these? So the simplest example, let us say the entity, the reporting entity, let us say it's a dealer in chemicals. Now, for that entity, upstream value chain could be, say, your manufacturer of the chemicals, right? And that's what you have to look at it. The chemical manufacturer, the emissions which are happening at this chemical manufacturer level will fall within scope 3 upstream emission. And likewise, once the disposal of chemical happens downstream, right, that would fall within other indirect emission in the downstream value chain of the value chain of the chemical dealer, that is the reporting entity. Now, if you look at this, there are 8 categories of scope 3 upstream emissions which are covered, which are given here in the at the top of the slide, which are there under the GHG protocol. So, for example, the easiest way is to look at it, say, for example, business travel. Now, business travel happening is, let's say that one of the employees of this entity, okay, uses an external third party, let's say Indigo Airlines business travel is being done by the executive of the company. Then that would represent emission under scope 3, which is upstream. Likewise, you have 7 categories of downstream emissions which are there under the GHG protocol, which are listed here. Right? So these are so in total 8 plus 7, that in total there are 15 categories of scope 3 emissions which are covered under the GHG protocol. There is also a concept of operational boundary. That is something, again, we intend to cover in the subsequent video. Essentially, this operational boundary determines which of the emissions. Now you can see there are 3 types of emission: scope 1, scope 2, and scope 3. So this operational boundary basically determines which of these emissions. Generally, scope 1 and 2 is required anyways to be reported, but in scope 3 emissions, there is a certain kind of an option which is available to an entity. Okay, so basically this operational boundary it signifies which of the emissions, okay, is something which we need to be included in the reporting of the carbon footprint. Also, it is important to note that under the GHG protocol, there are 7 greenhouse gases whose reporting is and monitoring is required. I have listed these seven the greenhouse gases which are listed on the slide. These are the ones which require reporting and monitoring under the GHG protocol. Now, what we'll try to do, we will try to deep dive into each of these scope 1, 2, and 3 emissions with some examples. So let us see what scope 1 emissions are in slightly greater detail. So as we have seen already, scope 1 emissions are those which are emanating from direct emissions, and those are the ones which are emanating from the sources which are controlled or owned by the entity. So for example, if you look at, let us say, if an entity is having, let us say, a boiler. We have already seen the example of a vehicle. Let's say a boiler or a furnace a factory has, okay, an entity has. Then in that case, the emissions which are emanating on account of, let's say, generation of the combustion of fuels in stationary sources like your boiler, furnace, and turbines, that will be one of the sources of scope 1 reporting. Likewise, you may have manufacturing or processing of chemicals and materials, for example, for cement, aluminum, or waste processing. That would also be part of scope 1 emission. Likewise, the third category could be the combustion of fuels in the entity owned or entity controlled, because the basic condition for scope 1 emission is that the source which generates emission must be owned or controlled by the entity. And therefore, if there is a fuel which is being used, let's say in mobile sources, for example, trucks, trains, ships, all of these which are owned by the entity or controlled by the entity, then the emission arising on these vehicles will also form part of scope 1. And then the fourth category, which falls within the scope of scope 1 emission, is the fugitive emissions, which is either intentional or unintentional release of the greenhouse gases, mainly like the HFCs emissions during the use of refrigeration or air conditioning. This is not, it may not be very applicable to all the entities, but for specific industries, this kind of emission is also applicable. So this is what is the breakup of what can constitute scope 1 emission. Of course, manufacturing companies and the office-based companies are likely to have different categories of the emissions within their carbon footprint. So let us illustrate this scope 1 emission by, for example, let us say during a particular financial year, a hotel, which is a reporting entity, let us say this hotel, a hotel operated one jet for the executive travel. This jet is either owned or is being controlled by the hotel. And this jet uses kerosene jet fuel. And the fuel which is being used as it burns emits CO2, methane, and nitrous oxide, which means these emissions are happening as the jet is being used by the company or the hotel in this case. So in this case, since the jet is owned or controlled by the hotel, the emission arising on account of the fuel which is burnt as the jet is being used will be reported by the hotel as scope 1 emission. Now, imagine the same situation that apart from the jet which is owned or controlled, as I gave an indication, let us say that occasionally the hotel executives, let's say, travel for business. Now, this particular the plane is not owned or controlled by the hotel. They are using, let us say, Indigo's aircraft. Then in that case, the emissions which is happening on account of that travel will fall within scope 3 category 6. If you see, we have seen there are 8 categories of upstream value chain emission 3. Then business travel happens to be the 6th category in that. So this use of let's say the business travel, if the business travel happens in an aircraft not owned or operated by the company, then in that case, the emission arising on account of that travel is expected to be reported under scope 3 category 6, which is the business travel. That's how you have to differentiate between scope 1 and scope 3. Now, what about scope 2? As we have seen, scope 2 is direct emission arising on account of purchased electricity, and the larger meaning of electricity is electricity, steam, heating and cooling, which is used within the entity. So like scope 1, scope 2 emission also occur within the organizational boundary. However, these indirect emissions happen because the emission is actually happening from sources that are owned or controlled. These emissions, because these indirect emissions, these are indirect emission because they do not occur from sources that are owned or controlled by the entity. As I gave the example of a state electricity board. If a state electricity board is generating power, let's say in a coal-based power plant, then in that case, emission is happening at the state electricity board. But because of the fact that the electricity from such state electricity board is being purchased by the entity and is used in its own business operations, this will fall within the indirect emissions which is arising on account of the purchased electricity. Right? That's how scope 2 emission will be looked at. So these emissions are considered as indirect emission source because they are the consequence. These are the consequence of activities of the entity, because you are using these in your business operations, but actual physical emission is occurring at sources which are owned or controlled by somebody else, in my example, state electricity board. So therefore, these are indirect emissions. Right? So scope 2 emissions capture emissions which are associated with the energy generated by a third party electricity generator, let's say a state electricity board, but is consumed within the entity's business operations. That's how you have to look at scope 2 emissions. And of course, almost all entities would actually be using electricity or some form of, the electricity power is steam or cooling, heating, and because of which everyone, though the degree may vary, but every entity is likely to have the scope 2 emission also in its carbon footprint. Let us illustrate this with the help of an example, and we'll see how this is to be understood. So similar example, if you look at, let us say, City Power is an entity. This guy, it is an entity. City Power is an entity which owns a coal power generation plant. So this plant is owned by City Power and it has generated 500 megawatts of power. Now, the entity, this guy, sells 100% of the electricity generated, which is 500 megawatt of power that is generated to a state electricity board. So to this state electricity board, which is a utility company, they are selling the entire output of 500 megawatt of power. Now assume, if you look at the third point, assume that that state electricity board, in turn, they are owning and controlling these transmission and distribution system, right? And this transmission and distribution system historically has been experiencing a loss rate of 10%. That means if 100 megawatt of power is handled by them, actually 10 megawatt is being used as a loss, and the balance 90 megawatt is something which is being, let's say, sold to the end user, right? That's how the transmission loss is historically being tracked by the state electricity board in this case, and therefore only 90% of the electricity is eventually sold to the end consumer. Let us say the hotel happens to be the end consumer who is buying the entire, this in my example, electricity which is being pushed by the state electricity board to the hotel. Now, in this case, the end user, the hotel, purchases the electricity from the SEB, State Electricity Board, and has used the entire amount it has used for its own operations. Now let us see in this chart how each of these entities will report scope 1, scope 2, and scope 3. So in this case, the power generator, City Power, is generating 500 megawatt, is producing and selling it to the State Electricity Board. And in turn, that 500 megawatt, out of that, 500 megawatt is being consumed because of the transmission loss, and the balance 450, 90% of the 500 megawatt is being sold to the hotel. So actually, the 450 megawatt which is being sold to the hotel is eventually consumed by the hotel. Now, in this fact pattern, how the reporting will happen? So if you see, the 50 megawatt which is being used for transmission and distribution losses, it is electricity which is being consumed by the state electricity board for its own business, own operations. It is scope 1 reporting for state electricity board. But then when it comes to the hotel, the 450 megawatt of power, the associated the emission, we are only using the power here, the emission will be calculated separately, that we will explain in a separate video. All I'm trying to explain that corresponding to this 450 megawatt of the power consumption, the emission which is there, that is a scope 2 emission for the hotel, because hotel is purchasing electricity. Purchased electricity is an indirect emission falling under scope 2. So for hotel, the emission on account of this 450 megawatt of the power which is being consumed is scope 2. And then if you see the upstream, that 50 megawatt of this consumption which state electricity board has used, effectively speaking, it is a scope 3 upstream emission for the hotel. But as I mentioned, that there is an option. This hotel, the end user may or may not report this scope 3 reporting under the GHG protocol if that entity is using the corporate standard of greenhouse gas reporting, GHG protocol. Now, moving forward, if you look at when it comes to the power generator, it is actually producing electricity. Also, therefore, there will be a credit in this, though scope 1, but here it is producing the electricity. Whereas, if you look at from the perspective of the state electricity board, the 450 megawatt which is being sold to this, for this state electricity board, this 450 megawatt power which has been sold, so the associated emission basically falls in scope 3 downstream, because downstream entity is your hotel. So that's how each of the entity will be actually looking at the carbon footprint in their own right. Now, as we said, scope 3 emission is something which is happening outside also of the organizational boundary. So like your scope 2, this scope 3 emission are happening outside the organizational boundary. Those 15 categories which we talked about, these are also indirect emissions like scope 2, but they do not occur from sources which are owned or controlled by the entity. Rather, these are the emissions that are part of entities' upstream or downstream value chain. That's something which we already saw. Also, scope 3 emissions are not required to be reported if the entity is following GWG protocol corporate standard. If the corporate standard is being followed by the reporting entity, then scope 3 emission is a choice. It need not be reported. Instead, an entity can elect. So out of the 15 categories, let us say the 6th category, which was for business travel, the entity may decide they may report only one of those categories out of the 15 categories, because that could be the only thing for which is applicable for that entity. And therefore, a reporting entity can elect to report one or more of the 15 categories which are identified under the protocol within scope 3 reporting. Entities that are required to report the relevant scope 3 emissions, then they will follow both, not only the corporate standard, but also the second standard which is there under the protocol, scope 3. This is something which we are going to cover maybe in a subsequent video. All we are saying in this case is that when it comes to scope 3 emissions, these emissions are the consequence of the activities in the upstream and downstream of the value chain of the entity who is reporting in this case. Right? And these are the 15 categories which we talked about. The first top line is the upstream value chain related emissions, 8 categories. And at the bottom, you have all the other 7 categories which are part of the downstream value chain emission reporting. This is what I wanted to cover in this particular video. I hope you are able to enjoy all of the videos which I have been sharing of late, and I have given my contact details both for the YouTube channel as well as my LinkedIn profile. If you think that it is something which is helping you in terms of enriching your knowledge, please connect with me in these social media platforms. And I would urge all of you that please support the channel by subscribing, commenting, and liking the videos. That will keep me motivated for continuing this endeavor. Thank you for now, and I will see you in the next video sometime later. Thank you. Bye for now. Take care.